Well, you're going to be looking at today's rally, of course, and whether it can last, though.
To dissect that with me, Carolina's Scott Bauer, CEO of Prosper Trading Academy. And Scott, happy Monday to you. And those who are long stocks are really enjoying this day. But it's another day of the haves and have-nots, only in reverse. Right now we have the S&P 500, the Russell 2000 at record highs surging, but the NASDAQ 100 down about 0.6%. That New York FANG index at one point down 2%. What do you think is ahead? Have we gone too far, too fast in both directions here?
Yeah, I really think so. And then you look at the small caps, the Russell and IWM, they're up 5-6%. And that's the area that I'm really focusing in on because that has made an incredible comeback, more so than the other indices, the small caps. And it's great. And this news is fantastic. But, just like you said, Abigail, I think it's too far, too quickly here. And I wouldn't be surprised to see a pullback in the IWM area to back to about 162 or so, which equates to the Russell right around maybe 1675 to 1680 area, just based on how quickly we popped up here. There'll be some big support in both of those areas in the small cap space.
That's pretty interesting because that would almost suggest that today's gaps higher on all of these different indexes and the correlating ETFs, instead of being bullish breakaway gaps, could in fact turn out to be the sort of gaps that will at some point fill to the downside. I guess we'll know more and perhaps also suggest that the ranges that we're seeing breakouts from, that it could be a false initial reaction. Stay tuned possibly for more volatility. How do you play this through the IDM and options?
So in the IWM, the small cap ETF, I'm going out a full month and change, out to December 18th expiration, and I'm buying the 170, 160 put spread, $10 wide, pay about $2.50, $2.75 for that. And again, I'm not looking for the apocalypse now. What I'm trying to do is be rational and say, okay, this is great news about the vaccine, but it's not going to happen so quickly, and we are in this second wave right now. So I think a pullback is warranted.
Okay, so let's now take a look at the stay-at-home trade, which today is really under tremendous pressure. You have your Amazons, your Netflixes, your Facebooks off. Also, Peloton. Peloton is down sharply. You think that this, too, is a reversal. But earlier, I understand you were bearish.
Well, no, earlier today we were selling some put spreads down when it was trading towards its low, like around 96, 97. We were selling put spreads. The stock has rallied back, and I'm even more bullish right now. And so now we're putting out, trying to buy some call spreads, again going out to December 18th, buying the 115, 125 call spread, paying about $2, $2.25 for that. Listen, again, we all hope that we get this vaccine sooner rather than later, but the brand name stay-at-home stocks, like a Peloton, it's not going anywhere. Fundamentally, yeah, it's very expensive, right? When you look at PE ratios and all that, it's very expensive. But the news they came out with last week with their earnings was phenomenal. They're way further ahead than they thought they would be.
Well, it sounds like you think that we're going to see a reversion to the mean. Scott Bauer, CEO of Prosper Trading Academy, thanks for joining us for Options Insight. And from New York, this is Bloomberg.